Good morning, everyone. This is Ben Thorpe with Farm Equipment Magazine. Welcome to our latest webinar in conjunction with Keiko Isom. Today's presenters are Mark Johnson, who's a principal with Keiko, who works primarily with equipment dealerships throughout the U.S. on financial and tax matters to position them well for business and growth succession. We also have Scott Bryn, who manages the firm's strategic advisory practice, assisting clients with buy-side and sell-side transactions, mergers, debt restructurings, and various financial analyses. Now, before they get started, I have two quick things I need to share with you. If you look on your screen, you'll see a control panel with a Q&A icon at the bottom. You can click there to submit questions at any time during the presentation. And at the end of the presentation, if we have time, we'll try to answer as many as we can before we hit 3 o'clock. And we are recording this webinar, and we'll have a replay of it available for everybody who registered after we're done. So that is everything I have. I will now turn it over to our very capable presenters. So take it away, guys.
Thanks, Ben. Well, today's topic is timely. You know, there was a time less than 24 months ago that we would have thought mergers and acquisitions would have been in really tough shape with COVID, pandemics, and everything else that's disrupted the world for the last couple of years. But that hasn't necessarily been the case. So we're going to kind of catch up on what we've seen the last 24 months and where possibly things might be going. There is on the screen right now is Scott and I's contact information. Again, if you're a dealership, I'm the market champion for our firm for equipment dealerships across the country, and work on a lot of mergers and acquisitions with clients and prospects. We'll talk about mergers and acquisitions, obviously, a lot in this thing, but a lot of times there's not mergers and acquisitions, there's also selling. And when a dealership is for sale, for instance, and I'm trying to find the best candidate out there to buy them and the best structure possible, that's when I bring in Scott's team. And so that's why he's joining us today, because Scott is all things transaction advisory for our firm. And so we've got some really good deals for a couple of clients in the last probably 12 months. And so if you're ever in that position, then I will introduce you to Scott as well. So as far as today's topics and takeaways or the agenda, we're going to quickly introduce just our firm, just really quickly, just so you know, do we have any credibility in what we're talking about? I always hate when I go to a webinar and think, man, where did they learn that? Because I feel like I know more than they do. And you might know more than us, but we're going to give you a little bit of credibility just to let you know that what we've done. The M&A client, both from, I'll speak a little bit about from the equipment dealership perspective, and Scott will talk about kind of overall worldwide M&A client climate. When questions come in, if they're really hard, I'm going to make Scott answer them. If they're easy, I'll answer those. Just kidding. If you could stump Scott, though, there would be a bonus in there for you. And then we'll move on a little bit past the climate and what's the best strategies and structures we ought to be thinking about as we move into these phases of our dealership? How do we influence valuation? How do we strive due diligence? How do we get ready for this whole thing and even drive that readiness thing? And then to the extent we can, we'll answer any questions that come up. And all along the way, we'll just kind of share with you what we think are best practices. So real quick on the credibility for Keiko Isom, you might notice on the bottom of our screen that you also see a name Pinion down there. More to come on that later, but our firm is going through a branding change as well, and Keiko Isom is traditionally our attestation wing, which would be if you get an audit or a review, we do it under the Keiko Isom name. Pinion is our everything else. So when we do advising and consulting and things like that. So you'll see more of that to come. So don't get confused on Keiko Isom or Pinion. We're the same thing. So as part of that, we're a pretty large accounting firm, about 450 employees right now. Our industry expertise, when you look at our website, you'll see that we are the largest firm in the country that focuses on ag. Most of that is on ag producers, but also on food and beverage, cycle or supply chains, things like that. So that's where the farm equipment industry comes into play. We're about $75 million in revenue. We'll probably be double that in a couple of years here. Recognized leader. So you see, we've got quite a bit of expertise in your area. On this map, you'll see the states that are orange are where we actually have physical location offices. So basically anywhere you can kind of see there that we follow the heat map of agriculture. That's where our offices are at. Anywhere you see a green dozer, that isn't a John Deere dozer is just happens to be green, that means we have a ag dealer in that state. And where you see a dozer, a yellow dozer, that's not anybody's brand specific. That's just where we have a construction dealer. So you can see we literally have dealerships across the footprint of the country. So and we're able to serve those as if they were local. As far as some of the services we do for equipment dealers, because we're so large, we've got about 40 plus dealerships that we're doing. That actually shrunk last year because some of our dealers went through acquisitions. So there was a case where we turned a few dealers into one dealer, and then when some of our dealers wound up being acquired by someone else. If you look at those dealerships, they represent about $9 billion in sales, so we're pretty extensive in that group. But we do a lot of, obviously, all the accounting stuff that you can imagine, auditing and reviews and tax return and tax planning, that kind of thing. Also, a lot of mergers and acquisitions, valuations from the standpoint of preparing for something like this transaction, or valuations that are needed to do estate planning and tax information and things like that. Do a lot of industry benchmarking, KPIs. So you could, from that list, if there's anything you're interested in, you certainly call us later. This wasn't meant to be a commercial, though. It's just meant to show you we do have credibility in the industry. So with that, I think I'll move on to where we're at as far as the climate. So if we back up a little bit, 2018 and 19, there's no secret information here. In fact, I think there might be a few missing, but I got all of these off Ag Equipment Intelligence website on the Dealers on the Move section of that, which we proudly sponsor. And you can see in 2018 and 19, there were a lot of transactions that happened. All these brand names that you see up there, some of them are now no longer brand names because they've been merged up into another entity or purchased by another entity and closed down after that kind of thing. But you can see a lot of names there. In fact, if you look at the number of locations that traded hands or changed the sign out in their parking lot, over 640 locations in 2018 and 19 alone. That meant 12,850 employees plus changed their logos on their shirts and their hats and their trucks and all that. And so as we went to market in those various places, a lot of employees were affected. And that's something that we sometimes lose count of, is how important it is to get all those employees kind of moving on the same page as far as the structure and the strategy of the merger and acquisition. If you look at the sales revenue that changed hands, just in those 2 years, it was almost $9 billion of revenue. So when you think about, is consolidation real and how big is it? $9 billion is a significant amount of the farm equipment sales revenue in a year. It's roughly a third or so of the market that year. So while 640 locations might not sound like that much to you, or 12,000 employees might not sound like that much to you, a third of the market size should. And so you can see lots of stuff there. Then 2020 hit. And for the first 3 months of 2020, it looked like mergers and acquisitions were probably going to be really hard to get done. Nobody wanted to talk about anything because nobody knew what the next 12 months were going to look like. Your showrooms are closed, all that kind of stuff. And we just didn't know what that was going to look like. But as COVID started to clear up, at least a little bit as far as opening showrooms and things like that, merger and acquisition activity took off. And any dealer on this call knows that 2020 and 2021, your revenues and your net income were as high as they've ever been in most parts of the country. There are a few exceptions, but in most parts of the country, high as we've ever been. And so that is ripe for mergers and acquisitions, and really specifically acquisitions. So you can see what happened on this slide. In 2020 through just recently in 2022, it looks like less transactions, but what you might notice on there is those transactions got bigger. It's kind of almost a third generation of consolidation, and especially on the deer side, you could see that the big ones started taking over other big ones. And so we saw some virtually billion-dollar dealerships put together on the deer side, and then on the AGCO and the case side, we saw a lot, and even on the Kubota side, there was actually a lot of transactions in 2020 and 2022. So not as many pictures on there, but you can see still 253 dealership locations changed hands, about half as many employees, 6,000. But on the revenue, 5.85 billion. So that's what I'm talking about. There were probably less transactions, but bigger scope within those transactions. So bigger stores, bigger bigger footprints when all was said and done. Comparing the 2 time periods, then you can see 2018 and 19 on the left, 2020 to 2022 on the right. 71 deals versus 44 deals, so again, not quite as many. As far as the average number of locations that traded during those time frames, that's probably not as telling because the transactions were different. I took 641 divided by 71 is 9.1. Not very telling information there, but a little bit. Employees, it looks at first like, that looks smaller. It looks like we traded smaller locations, and that's not true. What happened there is a couple of things. One, the other brands got more involved. So some of the Kubotas and the New Holland dealerships and things like that were 1 or 2 locations were involved in that. So that brought the number down a little bit this last year. But what also happened is those stores, we have a labor shortage going on, and the revenue volumes that we create, revenue per employee really significantly increased in 2020 and 2021 and 2022, such that we are right now over $1 billion of revenue per employee, which we've been striving for that number for a while, but got there in 2021 and 22. So then on the very last number, I think that is the most telling one. The average sales revenue per deal went from $126 million of revenue to $132 million. So that number did increase significantly to show that we're trading dealerships of bigger value. So Scott, does that line up with what you saw outside of the dealership world, or what's your perspective from there?
Yeah, I would say taking a kind of a broader step and looking at the global M&A market, 2020 was a record-setting year. It was the first time that they nearly reached $6 trillion in total deal volume. That was led by a couple of things. I mean, or actually, to put that a little bit in perspective, that's a 57% increase over 2020. Wow. Similar to what you said, those first couple quarters of 2020 were really slow. Deal volume almost just completely dropped off when COVID started. And then toward the second or third and fourth quarters, it picked up a little bit, and that momentum carried out through all of 2021. As far as the deal values, those also saw significant increases. And really a couple white hot industries were the tech space and the healthcare industry. I think average median multiples in tech were trading at 25 times, and healthcare was 20 plus.
Oh, wow.
So it was significant. The other thing that we saw a lot, or that played a pretty significant aspect of those increases, were that there's a lot of pinup demand from 2020. So while 2020 we saw deal volumes go down, that didn't stop fundraising. So fundraising was still happening in the background. So people were sitting on piles of cash that they couldn't spend because there's no
particularly in the private equity funds.
Correct. Yeah, absolutely. So as deals started coming up, there are fewer deals with a lot more competition. So people were bidding up those deals, which kind of goes back to what you were saying, an increase in prices in that 21, 22 time. So one thing we always look at is what's that look like going forward? Is this trend going to continue? So far, 2022, we've had pretty strong deal flow. Not quite as strong as 2021, but still significantly above 2019. So deal flow remains strong, but there seems to be a lot more uncertainty in the marketplace going forward. One of the main things is rising inflation, and we'll talk a little bit more about that on the next slide. Supply chain disruptions, and I know you say, well, we had supply chain disruptions in 2021, but I think the difference is 2021, we said, hey, we're getting through COVID. As soon as it's over, we're all going to be back to where we were. And that's not really the case. I think that people become less optimistic about how long it's really going to take for these supply chain issues to get fixed. And that's leading to more uncertainty.
The people on this call are living the supply chain disruption every day. The reason they can probably be on the webinar today is because there's so much less inventory out on the lot to sell, so they needed something to do today.
That's right. That's right. You also include that with labor shortages. I'm sure many of you are experiencing labor shortages. In order to keep that labor, a lot of, again, going back to inflation, you're seeing increased labor costs, so people are having to pay more to retain their employees. There's other just world events like the war that's going on in Ukraine that's affecting global gas supply and, again, driving up some of the different commodities. That's certainly impacting deals, and again, just the key theme here being uncertainty. And finally, along with inflation is rising interest rates. So as interest rates continue to go up, the Fed's moved several times and they're planning to move again. So as all of those kind of combine, 2022 is going to be a little bit more of an interesting year. So as I talk to clients this year, one of the main questions I always get asked is, what does inflation do to my business, or what does that look like from a valuation standpoint? And I say, well, it's not great.
Yeah.
With inflation, one of the ways the Fed has to combat that is increasing interest rates. So obviously, again, we've seen that. What that translates to is higher financing costs. So when you have higher financing costs, in order for people to get that return that they're used to, the only way to do that is to pay less for a business. So we may see valuations go down in 2022 as these interest rates continue to increase. Banks are also beginning to tighten restrictions. And so what that means is they may start lending less on cash flows because there's more uncertainty in them. So we're going to see a lot more deals with financing contingencies that potentially could fall apart. A financing contingency is usually included in language if somebody's going to go get financing. And to the extent that they're not able to, that could open it back up. And it's always harder to take it out for a second time when you have a first one that's failed.
I know in the transactions that I've seen in the last 24 months at least, financing never really came into play. Number one, dealers were sitting on a bunch of cash. Number two, their lines of credit were empty because inventory was moving out the door so fast. So I haven't seen a financing contingency in quite a while. So that is a big deal changer.
Yeah, and the other one too, this is nothing new, but seller financing requirements or alternative financing. I think we're going to start seeing a lot more of those. So from a seller financing, they may be looking for people to roll equity or potentially hold a note. So if they can't go get all the money they need from the bank, they may be asking, hey, seller, will you finance a portion of this transaction? We'll pay you an interest rate. So that works for some people and some people it doesn't, which ultimately may lead you in a different direction or potentially end up with a different buyer. On the alternative financing, I consider that more of kind of earnouts. So again, earnouts aren't new, but I think in order to kind of retain that deal value that you're probably used to seeing or hope to see, it may be required that you earn that value and hit key financial metrics for the next year or two in order to get that next payment.
You think those will be real earnouts, or in the past, it seems like when an earnout is put into a contract, the buyer did not anticipate the ability to earn.
Yeah, that's one thing we always have to consider is what those targets are and are they realistic to hit, and what control do you have in that? Typically, when you sell your business, you're relinquishing control. So to the extent that you have the ability to impact those results, is always something that we try to structure in the deals. Another thing that inflation is impacting is just higher costs around the board. We talked about labor, but all of your operating costs, your cost of goods, all of that stuff is ultimately getting higher. So when people are building out their models, it's one of those things where because there's uncertainty, they're taking a position to be more conservative. So as inflation goes up, we're going to see operating costs, cost of goods, all of that stuff is going to get increased, probably at a higher percentage of revenue than what we're used to. And all of that combines for a model with a lower ultimate valuation. So again, I think that all of those things combined, it may be a tough year.
I think one of the things that the dealers on the call might also be struggling with when they see this facing higher costs. We all know we're facing higher costs. Their revenue has been so high in the last 2 years, though, that as expenses as a percent of revenue, for instance, finally got down to the targets we've been aiming for forever. So I know in 2021, I saw most expense ratios for dealerships in that 9.5% to 10.5% range, which is what our goal has always been. But over the last several years, that's been 15 to 17%. So dealers on the call might hear you saying facing higher costs, and they're thinking, well, I've been more profitable than ever. That's because they lived it. And they lived the trend, but the buyer hasn't lived the trend. The buyer is, in their case, especially if it's a private equity firm coming in, might be someone that's looked at a completely different industry and says, holy cow, 10% of expense load and a 5% Noros, I don't know if I can live with that. So I think that's important for us to remember as sellers, that a buyer might be looking and evaluating us at a whole different level than we're used to. Again, why I brought Scott on the call today, because he thinks through these things a little bit differently than my dealership biased mind might. So
And one thing to point out though, and again, how a buyer may also look at this is when they see your revenue spike up, the first question they're gonna say, is that sustainable?
Okay.
So as costs have gone up, obviously we've been able to bring those prices up, but is that a sustainable level? How are we gonna kind of see a retrenchment of those expenses? So
With inventory allocations, we're also all asking, is this sustainable or not? So.
And so one thing I think that we're going to see that will really drive deal volume, again, taking away not necessarily focusing on a dealership, is what's the company's ability to really pass on these increased costs to their customers, right? So do you have flexibility in your pricing or your contracts? Even how long are contracts right now? If you have 2 years with a locked-in price on contracts, that's going to cause people to pause or potentially pull on the deal.
And what did you mean here by what's the due diligence? What changes with due diligence because of that?
So with due diligence, again, as there's more uncertainty, what we're also seeing is kind of these longer exclusivity periods, and that's coincides with more extensive due diligence. So some of that is that contract review, and it's really causing people to go look and say, is this revenue sustainable? What other factors are impacting that, and how much longer is this? Are we going to see this, price increases? So it's going to be a more thorough diligence analysis, and it's going to be a lot more involved. And ultimately, when we work with clients, what we love to do is get out there, a couple years ahead of somebody wanting to sell, because ultimately your key for due diligence is really holding that value throughout the process.
Right. All right, so speaking of process, if you've been on one of our webinars about M&A before, you've seen this picture. It's not important that you understand or you can even see everything on this picture. But the point about this is the M&A process, more than ever right now, is exactly that. It's a process. And too often, when a dealer comes to us and says, hey, we're ready to do a transaction, they've got two things in mind: valuation at the beginning and cash at the end. And everything else in between is kind of noise and pain in the neck, and lawyers and attorneys and accountants trying to get this process in place that just seems like it drags on forever. But the point is, when there's this much uncertainty in the market, we've got to make sure, first off, we start with a valid model. We know what our growth rates are. We know what the drivers are that make our dealership successful, so that whether we're merging or whether we're selling or whether we're buying somebody, we know what those drivers are after the fact, so we can come back and say, did we get what we thought we bought? Or did we sell what we thought we sold? And did we get a fair price for that? So it's almost, we get the cart before the horse when we start talking about valuation first. We really need to understand the rest of that. So if you're getting ready to think about doing this, just know that approach it with a disciplined process in mind, and not just how fast can we sell this thing. It takes a while to ramp up to get a transaction moving. Strategies and structures. So depending on what kind of entity you are, sometimes the merger and acquisition process is harder or easier, but all entity types are going to have hurdles. So I don't even know anymore. It used to be, if I was in the south part of the United States, most of my dealerships wound up being C corporations, because that was the thing that everybody did down there. If they were anywhere else, the most popular was S corporations, with a few partnerships thrown in here and there. Obviously, the S corps and the partnerships, many of you are that because it was a way to pass through the income, tax that at the ownership level versus at the entity level, and so that's what wound up being a pretty popular model. But all of them have some hurdles, and so particularly we're talking about mergers. For instance, an S corporation has to be owned by it has ownership limitations. For the most part, it has to be owned by a person. It can't be owned by an entity unless we clicked off some boxes to make that happen. And so if we've got an S corp trying to merge with a C corp, that doesn't always work. And we also have the thing of an S corporation. You might be paying yourself a low salary because you're taking out distribution, because we don't have to pay self-employment tax on that. Well, all of a sudden, when we're trying to compare two entities together, an S corporation versus a C corporation, one we have to pay salaries because we don't like dividends, and the other one we don't want to pay salaries because we like to pay dividends because they're taxed differently. And so it's hard to compare those two. On a C corporation, it's hard to get an asset out once you put it in, because we've put it in there in a tax advantaged way. And so it's a tax disadvantage to get it out of a C corporation. And so we've got the issues around removal of assets or transferring assets around. And so we have to be very careful in a C corporation. And in a partnership, sometimes we haven't even sold anything, and it turns into a sale because we have some deemed sale rules of when we change the ownership by too much percentage, it's as if everyone else sold, and so we've got some deemed liquidation, as well as different assets get treated differently, and some are hot and some are not. The hot ones are ones that have basically appreciation on them, and we have to pay tax on that appreciation. And then the whole LLC, that many of you might raise your hand and say, I'm not an S corporation or a C corporation, I'm an LLC. And what is an LLC? Well, from an IRS perspective, an LLC isn't anything. An LLC is a state designation for liability protection, but it actually has to pick a box to say, well, what kind of entity am I going to be taxed at? And sometimes you might not even know that. You say, I'm an LLC, but you're either taxed as an S corporation, a C corporation, or a partnership. So it's important to find that out before you get into this process as well. I say that because when we start choosing a strategy or a structure for that merger and acquisition, it becomes very important to try to figure out how to do that, particularly in a merger, tax-free, because the last thing we want to do is put two companies together, have some tax impact, take a lot of the value off the table, and neither the buyer or the seller winds up with access to that. So often what we see in a merger scenario is we create a whole nother entity, which is one of these elusive LLC concepts that we put up at the top of everything. And everybody kind of, you can see here, they transfer their assets into the LLC and take back ownership. May or may not transfer their real estate in, but definitely transfer their operating assets in. What happens there is that new co level where you see the new sign on top, that's where your contract with your OEM would wind up being. And so if you're a dealer that's got an OEM contract, it's sitting there at the top. We do have to get a new one, and then we all do business as the new entity. This kind of structure also helps us deal with, or if we're bringing in, so for instance, if we were an S corporation, we can't have any other ownership. We wouldn't be able to bring in a PE company or other outside investors that are owning their investments inside of an entity, but they can own an LLC. So our S corporation can still exist. It just transfers its ownership up into the LLC, or transfers its assets up into the LLC, and the other owners take back ownership. It helps us deal with that. It helps us deal with different fiscal year ends. So if one entity is a June 30th year end and one is a October 30th year end, and we try to merge those two together without going through another entity, we got to pick one year or the other, which means one entity might have to pay 2 rounds of tax. Similarly, if one entity has their inventory on LIFO and the other one on FIFO, we got to pick one. We can't have assets on both, so we'd have to either most likely the LIFO person elects out of LIFO again, and we pay the tax on the appreciation, which isn't bad in a time period like this where inventory is low. It is bad switching to LIFO in a year like this could be good though, because the price of inventory has gone up in some manufacturers by 20% plus, and so switching to LIFO could be a one-time tax relief for the entity that's electing LIFO. If we've got deferred compensation or deferred taxes or other assets and liabilities, it also makes them easy to deal with that because we can leave them off the table. So if Scott and I both own a dealership and we're merging together, and I've been very tax aggressive and Scott's been very tax conservative, and Scott doesn't want to take on my aggressiveness. And so what we can do is leave my aggressiveness in my entity, and I only transfer up real assets and real liabilities into NewCo, and then Scott only has to deal with those, and he doesn't have to deal with my issues there. So anyway, this is one that as you're thinking about mergers, this is a strategy that we often employ. Scott, is that similar? Do you get into this side with other entities? When they're going through mergers and acquisitions, they often change their structures, or they elect new ones?
That kind of goes back, and it's really dependent on where we get involved in the process. So it's much harder to do tax planning, which often becomes a significant part of the total dollars in your pocket that you referred to earlier. It's harder to implement a lot of these strategies when you've already started talking and you're 90 days away from the close.
Right.
So to the extent we get in and work with clients earlier, we often will look to see if it makes sense to switch an entity structure to, take advantage of tax impacts.
Yeah. The one of the industries you said was hot was the software industry, and I imagine those usually sell before they even make money. So they're trying to figure out what to do with their net operating losses and things like that, and everybody harvests those the way they're supposed to, which has gotten harder and harder over the years. So, okay, so valuation, as you can imagine, valuations skyrocketed in 2020 and 2021 because profits went up. If profits stayed up, and we knew for sure they were going to stay up, then valuations would also stay up. And so when we're thinking about how to influence a valuation right now, I think I'm going to hit the basics real quick in case you have heard some of these terms but don't know what they mean. So there's a few different ways that dealerships, and Scott, chime in if there's another way of non-dealerships do this, but so we often hear about EBITDA multipliers, or we hear about discounted cash flow, or we hear about book value. So all of those are three different concepts of value, but they all deal with timing of that measurement a whole lot differently. So as you can see here, if we were going to value your dealership today, the easiest one would be to do it on the book value, right? Because that is, we know what it is today. Or even if we said not book value, but fair market value, we could always kind of look at the assets and say, okay, I own these 5 assets and I own this much inventory and I have this much debt. We can figure out a fair market value on that, and that is today's value. What that doesn't calculate, though, is if I can turn my inventory over multiple times, if I've got a client base that has allowed me to have very good margins and things like that. It doesn't capture any of that. It just says, what am I worth today? And so that's right there in the middle. Very few dealerships are sold. I hope you would never sell on book value. Now your buy-sell agreement where you sell to your other shareholders, that might be on book value, but very rarely would you ever go to market and say, hey, my book value says I'm worth $100, so I'm going to sell for $100. But that is easy to figure out. The discounted cash flow
Hey, Mark, Ben Thorpe here. I'm going to interrupt you. We lost your audio, actually. If you're able to, I'm not sure if you can hear me. We'll connect with Mark real quick.
because our revenue doesn't grow. Especially if margins are somewhere in the 5 to 20% range, and
Let's make sure we. Looks like we lost our volume.
Oh no, great! That would be really good.
Is our volume back? Good.
Oh man.
So lost audio at DCF. Can we go back and talk about that?
I'll talk about DCF again. Discounted cash flow is looking at future cash flow we can generate, basically based on EBITDA, but also if you think about discounted cash flow, it would be the cash flow that we have free to invest in other things. So we have EBITDA, and then that generates cash flow, which is EBITDA is earnings before income, taxes, interest, depreciation, amortization. And so that's almost a cash flow. What turns it into cash flow is our change in inventory, for our committed costs of capital, for improvements in fixed assets, things like that. So that's a future look, where EBITDA is a prior look, and saying that's how much we generated back then, we're going to generate that in the future. When I change slides here, hopefully that caught everybody up, I hope so. When I change slides here, what we're looking at now is the difference between how hard are each of these to do. And I see somebody's asking about multiples. I'll address that in a second. So the revenue multiples would be the easiest, but nobody trades on revenue because, like last year, you might have gone from being a $50 million dealer to a $100 million dealer. That didn't necessarily mean you doubled in value because your margins and your net return on sales was much less than that. Your net income was much less than that. So revenue multiples are very rarely used. In fact, I wouldn't even know what the multiples are. Scott, have you ever seen a company trade on revenue multiples? They must, because I can see it in the textbook.
Well, generally, a lot of times when you look at a revenue multiple, all they've done is said, this is what the company sold for, and they'll back into what that would be. So it's more of a mathematical equation.
Afterwards?
It's
Okay.
more after.
Very good. It would be very easy, though. It would be extremely easy to calculate that. Another easy one would be the book value or the tangible operating equity, as somebody might call that. That would be very easy, but again, not necessarily a very good price because our book value it's not as beat up as our tax value, but it's still not the value that your dealership is worth. So those are easy. If we switch to the hardest actually is the one that if you ever sold a house, an appraisal is basically precedent transactions, sometimes frustratingly so. So you sell your house and the realtor says, hey, here's the multiples that other houses, or here's the dollar per square foot or the comparable sales of other houses in your area, and that would be a precedent transaction. That would be hard in a dealer, easy in a real estate market, hard in a dealership market, just from the standpoint of you don't usually publish that information. If everyone was a publicly traded entity, that's easy to do, but very few dealerships are, and so precedent transactions would be the hardest. The next hardest, though, would be that discounted cash flow, because not only are we trying to project out income, we're also trying to project out cash. More importantly than projecting out income, because we want to know how much cash are we going to generate in the future. So we need to know how we turn income into cash flow. And then EBITDA is kind of right there in the middle. And so we can see the easy to hard on how to do it, but also the easy on hard on comparability goes from bottom to top. So comparability, it'd be again easy to compare revenue. But it's hard to compare book value, for instance, because one company might be, all the real estate might be in another entity. And so we've got some rent payments going back and forth where the other entity might not. So it's very hard to compare those. So those are our different valuation models. And you get my mouse, there you go. Okay, cycles and timing. So this is just one more look at the same methodology and where we would be at as far as the cycles and timing on these. So you can see we're going from on the horizontal axis is historical versus future, and so this is as revenues and incomes go up. Where would we want to be? So historical, obviously, EBITDA and precedent transactions, that's looking past. Discounted cash flow, like I said, is looking forward. But more importantly, in the vertical axis is going from growth, we're in a growth market versus decline in the market, which I don't know where we're at right now, frankly. It feels like we're still growing. But like this year, for instance, dealerships are probably, our estimation is it's looking like dealerships, if they can get inventory, are still going to have in that 5 to 7% growth rate, but that's somewhat fueled by the inflation part. So we've increased prices by 20%, and we're still going to we're going to limit our growth to 5 to 7%. So is that growth or is that decline? I'm not sure. Net income is still going to probably grow. Revenue is going to grow, but it's not necessarily from operating. And so as we look towards decline, if that was where we were going to be, where we would, the EBITDA is a past look. So if we're saying we generated, $50 million of EBITDA last year, are we going to generate $50 million in the future? Probably no. If we're not, then it'd be really difficult to value our dealership on EBITDA because we're not going to be able to sustain that. So that's just timing. When I look at what some of those multiples are, and I think that was where that question was heading. It's hard to say because it's hard to be comparable. But generally, if EBITDA multiples were in the 3 to 5 range back in the 2017 to 2018 range, they got up into the higher parts of that, into the 4 to 6 range in 2020 and 2021. Discounted cash flow is all about risk, so that's very. We have to understand the dealership itself to understand what discounted cash flow, because we're gonna discount that cash based on risk. So, do they have high market share? Do they have high expense load? Are they in a market that is dairy versus row crop? So those all impact what my discount will be. So I don't know that we could come up with a discounted cash flow risk rate that would be normal. I think from what I've seen, you generally a closely held business is somewhere in that 15 to 20% discount rate. Dealerships, that's usually where I'm at too. If they're not a very profitable dealership, or if they're a very low market share dealership, I usually see it in the 22 to 27% discount range. Is that similar to what you've seen in markets?
Yeah, I think, if you're talking about a private equity buyer, at a minimum, you're starting at an 18% rate, and it's going to go up from there. And on the dealership side, are you seeing price premiums for larger dealers?
Yeah, very much so. And I'm seeing price premiums, especially when we've got high market share. The reason why isn't necessarily because the private equity firm is thinking exactly like the manufacturer. Private equity firm is looking at it saying, how easy is it to sustain sales you had? And if I've got 50% plus market share, then I've got a pretty good customer base that's going to keep coming back for more. If I've got 15% market share, I'm always competitive. I'm always got a competitor in that deal with me, and it's harder to make sure that I've got that. So definitely, the bigger the dealership, the bigger the multiple. At some point, that flattens, though, right? Because you can't, if you generate $100 million in sales, and you've gotten to the point where you're able to convert that to be $15 million of profit, there's a capping point in there where it feels like I can't get paid for every dollar that you have, because I don't know that my structure will be as profitable as your structure was after I bought it out. So that's sometimes a little wonky here. Transaction type, we always call it M&A, and I don't know about you, Scott, but it always bothers me we call it M and A, because it seems like it can't be both. It's M or A, and that really doesn't actually. A would also, which is the acquisition. M is the merger. Acquisition would also be if you're the seller of sale. But there's when I think about methods of valuation, whether I'm doing a merger and acquisition could also be important to know here. So when we're looking at a merger, we're not converting it to cash. We're converting it to a percentage. Where an acquisition or a sale, we are actually looking at converting that is a dollar amount. When I look at a merger, the drivers impacting my company, we've got external drivers of the economy, of the manufacturer, of how much inventory we've got. We've got the internal drivers of how profitable I am, how much deferred maintenance I've got on my buildings, how good are my employees, and then growth opportunities. Talked about market share a second ago. If I got 80% market share, it's kind of hard to get any more. If I got 30% market share, I got a long way to go. But if I'm looking at two dealerships buying one another, we got to make sure who's paying for that growth opportunity. Bottom line is, in a merger, we just got to make sure that both companies have a valuation that's very consistent with each other, very comparable, and it's complete. Sometimes we leave some of that off. On an acquisition side, we have to make sure that are we acquiring everything, or are we leaving the real estate off the table? Are we leaving some of the life insurance and things like that off the table, and the selling owner is taking it with them? Is there some employee or management transitions that need to be reflected, like the owner is also the CEO and the best salesperson in the company? Is he leaving after the transaction is done? So the dealership is probably not worth as much tomorrow as it was today, and then how much goodwill and what are the terms of that transaction going to be, which aren't as important on a merger because there aren't terms. A little bit of a reminder is goodwill is back in vogue. If I went back 2014 and 15 after we had the big dip, goodwill was unheard of. In fact, it was a dirty word. But a goodwill isn't always, is really, some people think of that as the difference between book value. If I got $10 million in book value and I say I'm worth $50 million, some people say $40 million in goodwill. That's not necessarily true. Inside of that $10 to $50 million upside is we got assets that we depreciated, we're going to recapture those. We're going to take assets on and off the books. We might not sell everything. We've got unrealized benefit of recent investments. So if it's a dealer that's gone through several different mergers over the last few years, they might not be mature yet. So we might have bought somebody in June of last year. We only got 6 months of their data instead of 12 months of their data. When we look at saying, okay, but we own that dealership now, not just half of that dealership, we've got to make sure we get that unrealized benefit booked. And so those are things that would be really not necessarily goodwill. You see that similar in other markets, I assume?
I do, and that's, we're talking more on an asset sale here.
Yep.
Right, so there's always a portion of that gets misconstrued, or it's kind of a forgotten cost that you end up paying in taxes.
Right. Then so what is really goodwill? The way I define goodwill anyway is, can I generate a return on return on whichever you like to look at, return on investments, or return on investment, return on assets, or return on equity. I look at them kind of differently depending on the dealer. But if I can generate a return that's higher than the risk rate, then goodwill comes into play. And so some of the intangible stuff I'm looking at that point are, does my dealership have some employee and some managerial strengths that would transcend a transaction and make us go from the whole 1 + 1 = more than 2 kind of thing. Do we have market strategies and positioning in our market that we've got a lot of upside potential in there? And so those would be some intangible stuff. On the historical and projected rate of return on equity, bigger than our risk. What the risk we're looking at is there's 4 different risks. So there's risk-free rate, which is essentially that sounds like weird, like risk-free rate. I define that as how the government loans money to the banks, because that would be risk-free, and that number has doubled in the past year and a half. So it's gone from virtually 0 to about 2.5% right now, and that'll probably be about 3% by the time we get to the end of 23, I'm guessing. But then we've got industry risk. How much risk is there that the industry is going to continue to grow? Is there some decline coming? Then we've got company risk. What's our infrastructure look like? What's our staying power look like in the industry? And those all combined are the goodwill risk that we discount that cash flow back from. Okay, I'm going to hit these kind of quick because I'm going to look at my watch here. Scott, all my dealerships, we always have to do some true-ups, whether it's on the balance sheet or the income statement, because we've done things differently than others might have done. I assume that's the case on everybody except big publicly traded companies, but I always preach my dealerships, the cleaner we can get before a transaction, the better, because anytime I've got to say, I made $1 million last year, but it was really $1.2 million because I paid myself more rent than I should have, or I paid myself more salary than I should have, or I had these weird transactions in there that didn't make any sense. How does the market look at that when I've got to do all the true-ups?
Like you said, it's great to get ahead of those. And earlier you're talking about, if I hold the real estate in a separate entity, that's great. But if it was in the same entity and you present an EBITDA, you may not have had those rent adjustments, right? So that's going to be something that also detracts from that. So there are positive and negative adjustments. And the cleaner you can get it starting off with, the cleaner your information looks, the better off.
Good, Tom. Preaching the right message then. Like I said, they're both on. So some of the ones on balance sheet, Scott just mentioned there, I've got the same thing. Related party, we have off balance sheet risk. We have some bookkeeping cleanups, but also on the income statement, there'd be the same. Are we underpaying or overpaying our salaries? We have a lot of benefit to owner expenses like stadium tickets and charity and things like that. Is there anything extraordinary, or do we just beat up our books because we don't like paying taxes? Due diligence. First off, there's a lot of information that's going to trade hands during due diligence. Your attorney's list is going to be longer than anybody's list because they're going to make sure that there's nothing left unturned. There's some industry standard checklists that we would look through, but really the due diligence is we've got to justify that everything we said is going to happen in the future could happen, and everything that happened in the past has been documented. We don't buy stuff that we didn't mean to be. I'm going to look at the questions here real quick. Okay. No, none yet. All right. I'm fast forwarding here because you are going to get these. Okay. So messaging. Process. So whether it is putting together your models or putting together your forecast, or whether it is looking at who is available to buy or sell to. There is processes that you need to follow to make sure we aren't just focusing on valuation and cash flow. And that process is a tough one. So we need to make sure that whatever we're after during this M&A process is worth it. Sometimes it is just generating cash flow. It's monetizing an investment that you've had or your family's had for a long time. But it might be that we want to go to the next level. So is the monetization worth it? Is it going to the next level worth it? If there's not a strategy behind M&A, I would never suggest just saying, hey, let's try that, right? At the end of the day, one culture is we need to take two companies together and choose the best from both of them. And that won't happen by itself. That has to be an intentional process that we often suggest that we actually do kind of a culture capture at the beginning of the process to say, what is our culture and what is their culture? And can these two things come together and still make money? Expectations are important, but only verbalized. So if you've got some expectations or some sacred things that you want to make sure happen during a transaction, if they're not verbalized, they don't make it into a contract. Conflict will happen during the process. Expect it. Use it to an advantage, because that, oftentimes the conflict might be understanding what the model might look like, how much we're going to pay ourselves in salaries, how much we're going to spend on training, how much we're going to spend on all our culture. Our cultures are different. That conflict would maybe help us figure out whose is better, because less than a year after closing, all we care about is performance anyway. And that's why we did it to begin with. We might think that we've got to do something different to sustain ourselves. We might think we need to do something different to grow more market share. Whatever that is, the performance will measure that later. All right, so Ben, I'm going to turn this over to questions. If you've got any yet so far, I'm not seeing too many on there, but we also did something weird to our screen and lost some of them. So do you have any questions for us?
Thank you, gentlemen. That was very informative. I did have one question from the agricultural intelligence. You don't hear me? Hello? Hear me, Mark?
Yeah, I can hear you.
Okay, there you go. My question was going to be, and you alluded to this a little in the beginning, the pandemic created kind of a built-in for M&A activity, stuff that had been started, then got put on hold, and we saw a lot of that happen, unfold over the last year. Do you think there will be a similar kind of effect as we're dealing with these equipment shortages, supply chain issues? Because I was reading an interview with a certain manufacturer executive who believed that at this very moment, we are only halfway through the worst of the problem. So he believed we're looking at a couple more years. Do you believe that will have some sort of effect on the culture of M&A in North America?
Yeah, I think it would have to, because even if it's probably different if two dealers are coming together versus a private equity firm or an outside person is coming in. Two dealers might have the half glass full thing that says, hey, we've dealt with this before. In fact, 2022, we don't have any, our inventory allocations are low, but we've got everything pre-sold that is coming in. And so the bad parts of inventory, we're not scared about at all. We're not scared about winding up with too much inventory, which is in the past been what we've been scared about in mergers and acquisitions when the cycle changes. But the outside person coming in doesn't know that, right? And so they're going to look and say, you had 5 turns last year on your inventory, and this year you're not getting in inventory fast enough to turn it like that. So that would be a concern. Now, the thing that concerns me even more probably is the impact of sales mix on valuation, because when we look at overall return or net income, we've got equipment that sells at somewhere between 5 and 10%. We've got parts that sell in the 30% range, and we've got labor that we can usually get 60+%. And that mix has gone from being about 30% aftermarket to about 20% aftermarket, because we've selling so much equipment in the last 2 years. And so we're selling a lot more of a lower margin piece right now, but we're selling so much more that it's made it look like we were very profitable. If that changes and we don't have the inventory to sell, that sales mix has really made my balance sheet or my income statement look a little wonky going forward, because I don't know how to predict it as well. So yeah, there is a lot of uncertainty that's going to just really try to understanding what our modeling is going to look like looks a lot different. And just anytime you have to say, I'm not sure, or this is going to change a lot, or this won't look the way it did last time, that leads to an investor saying, oh, so what do I need to know about you? Why is things changing so much?
Great answer. That makes sense. Great. You're right. We do not have any other questions. If anybody wants to get in a last minute question, actually, someone just submitted one. This is from an anonymous attendee, and it reads, many non-Deere dealerships are represented by multiple OEMs. Has the buyer market discounted those types of businesses versus pure single OEM dealerships? Meaning, is there a complexity discount being built into the market?
The real answer to that is, I think, yes. I think the discount is just from the standpoint of, do we have enough volume from each one of those to get the attention of each of them? So, if you're a dealer that sells 12 different lines of equipment versus 2, do I sell enough volume of any of those 12 lines of equipment to get the attention of that manufacturer to keep my inventory allocations coming in? Versus if somebody else is selling, if I'm a Deere dealer and I've got 80% market share, Deere's going to make sure I get all the inventory that I can get, and I'm going to be able to sustain everything I can do. If I'm 15% market share overall, and I'm selling 12 different lines of equipment, and those different manufacturers have to decide who am I going to send inventory to. As an outside investor, I'm going to say, holy cow, I think they're going to have a hard time getting their allocation in there. Now that might not be true. So you might be a very a star dealer from those lines, and you're going to get your inventory allocation. But the outside investor doesn't know that, and that's where the uncertainty comes in: is can I get that? So I think there is a discount in there. On the flip side, if you're a Deere dealer with low market share, you're going to get discounted as well. So for the same purpose or for the same reason, am I going to get enough inventory that I can turn it around fast enough to sustain the profits that I've had over the last couple of years?
Sure. Okay. And that person also asked if you'd seen any OEM purity issues cause dealer acquisitions to unravel.
Yes, very much so. Over the years, I've had some, particularly if you think about over the years as mergers happen, there were a few dealers that, like a Deere dealer, that might have still had Kloss, or a Case dealer that might have still had Kubota. And when they go to get approval from their manufacturer to merge or do a transaction, the first thing the manufacturer says is, to that Case dealer, I'll do that if you get rid of your Kubota, or to the Deere dealer, I'll do that if you get rid of your Kloss, because we need purity going forward. Well, if you're that particular dealer, or the dealer buying them, and you see that 20% of my sales might have come from that line I'm getting rid of, but that line was 25% profitable versus 10% profitable,
then all of a sudden my dealership is worth a whole lot less than I thought it was worth, or whether I'm the buyer or the seller. And so that purity really takes some net income off the table that the organization going forward won't be able to continue. So yes, that can unravel a deal. You got to ask yourself, is it worth it? To my point earlier, is it worth it going forward if I'm going to take that off the table? It is if I'm the seller and I can sell it twice. I can sell my Kubota to this guy, and I can sell my case to this guy. But if I have to just lose one and a contract winds up going away, then yeah, that's going to unravel a deal.
Sure. Okay, I know it is 3 o'clock. We got one more question. Can I give it to you? Do you have time?
Yep, go ahead.
Okay, this one comes from Jared, who says, post a merger or acquisition, is there a longer term success correlation or lack thereof of the new entity if the stakeholders use a trusted advisor like Keiko versus doing all the work on their own with no help?
Well, I've got a very biased answer for that. Well, if it's anybody else but Keiko, it's going to not work. No, just kidding. But I think you have to have an independent look at that thing, whether it's us or whether it's anybody. I think when you're highly invested in your prior culture, it's really hard for you to see the benefits of changing, and from either side of that transaction. And so, you can't see past, this is how we've always done it. And so unless you hire somebody to look at that for you and help you kind of understand that, even if you're the most open-minded person ever, it's just really hard to do that. I know when we, as a CPA firm that counsels people all the time, when we go through mergers and acquisitions ourselves, we do the same thing. We often hire people to say, hey, help us understand the culture. Hey, help us understand why they look different than we do. And so even professional counselors like ourselves in a transaction hire that done. And I don't think there's any way, I shouldn't say that. Sometimes you luck out. Sometimes you're buying somebody or merging with somebody that's so much smaller than you, it doesn't really matter. You're really just buying their employees or you're buying their locations, and so it doesn't necessarily matter. But for the most part, I would have to say there's a 90+% correlation of long-term success to making sure you understand things from someone's perspective other than your own.
Great. Okay. That is going to wrap it up for today. So today's presentation and audio will be made available on Farm Equipment in the event you want to go back and review. I know we lost some audio there, so if you want to go back and take a look at those slides, you can. Actually, Mark, do you mind jumping back to the beginning where your contact information was, just so people know I want to get a hold of you? Kevin, I do see your question. We are out of time, but if you want to shoot them an email, their email's right there. So on behalf of Mark and Scott, the Keiko Isom team, and myself at Farm Equipment, we want to thank you for joining today's webinar. Feel free to reach out and let us know what you thought of today's live event and if there's any topics that you want us to cover in the future. So thank you again, everybody. Thank you, Scott and Mark, for your time. And everyone have a wonderful day.